You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. It's Trent Fleskens, your host, as always. This week, we are running into an introduction to the commercial property market, and we thought we would tie that in with comparing that to the residential market, because we've spoken for 154 episodes most consistently about the residential market. We've only had a couple of episodes in the last year or so with Anthony Morabito about some commercial aspects. Today, we've got one of the commercial real estate agents in Western Australia I respect most, and that is Luke Randazzo from Burgess Rawson in. Luke, thanks for coming in.
Thanks for having me, Trent. Excited.
To chat about those really basic understandings for all those people who have been listening on, thinking about subdivision development, passive investment in the residential space. But what about the commercial space? We have a lot of clients that are now talking to us about that option. It might not be for them, but also with a bit of information today, that might be something they start to look further down the line on. So, Luke, where do you think we should be starting? For me personally, it's getting a really basic understanding of just the differences between resi and commercial in terms of how the markets are going right now.
Yeah, absolutely. I think there's definitely a misunderstanding in the market that the commercial market is booming at the same level the residential one is. So we're certainly having a strong sign of growth at the moment through our market, but it isn't a matter of putting a property on the market and then putting it under offer over the weekend. The interest we have is generally from owner-occupiers and investors. Low rates are really driving people to try and get some form of return rather than what the bank is giving at the moment.
And that's the point of commercial, isn't it? Most people who buy real estate in the residential space, they're thinking about long-term capital growth. It's less really about the rental yield because it's not that fantastic when you think about all the costs you've got involved, especially given the fact that in the residential market, you're still paying for your rates and or your property management and all those things. We'll talk about the differences there with commercial. With commercial, it really is a substitute to some other bank investment or share investment, whatnot, when it comes to a yield, right?
Yeah, absolutely. And that's where, even as an investor, there's a number of classes in terms of investors that are chasing capital growth, and those ones will target green title properties that have land rich and chase some form of growth in the land itself. And then there's also investors that just chase a pure yield play. So they're just going for a tenanted investment and they buy it on a percentage on what that return is. So it could even be a strata, and it's just all about income, passive income, set and forget, get paid on the first of the month, every month kind of thing.
That's a really specific way of valuing property that we never would have spoken about before in residential, and I really want to get deep into that soon. Let's talk a little bit more about the market itself, and we definitely will have an episode soon of going a deep dive in there. But as you referenced before, the residential market, it's been booming for the last year or so. It's been quiet for 5 years, 6 years before that. With every reasonably good property, we've got 10, 15 offers most of the time at the moment, where it could be sold within a couple of days if you wanted to. Prices have gone very clearly, and you can compare these very easily in the residential market, up between 15 and 25% in most suburbs. However, as you referenced in the commercial market, it has been just as quiet, maybe even, if you can imagine this, quieter in the commercial market for quite a few years. And that's different sectors. Some sectors have been okay, some have been worse than I said. But it's on the recovery path. But as you referenced, nowhere near as crazy as the residential market.
Yeah, look, absolutely. I think the last 6 months in particular is one of the best markets I've been a part of for the past 5 years. And again, I just think it's been driven by low interest rates. The owner-occupier market in the commercial space is quite incredible. We're seeing a lot of tenants who are now becoming owner-occupiers, so they're weighing up the difference of what their monthly rental payment would be versus what the monthly repayment on a mortgage would be. And because rates are so low, it is making it much more affordable for someone who might have been an office tenant in Netherlands to then become an office purchaser in Subiaco. And that's driving the owner-occupier market in our business really well, really strongly. And then, as I touched on as well, the investor market, because no one's getting much back from the bank at the moment, everyone's hungry for a yield play, and that just sharpens those yields up for a set and forget investment.
When we walk around West Perth, Subiaco, even St. George's Terrace, we still see a lot of empty offices. We see a lot of for lease signs, some for sale signs. Where we're going in the next few years, are we eventually looking to see these things full, or is that just, is it demonstrating more of a shift away with people working from home these days? How has that affected the commercial market?
Yeah, no, absolutely. And the three suburbs you just touched on, Subiaco, West Perth and the CBD, they're all their own suburbs. I couldn't even group those together because that would be unfair. The office leasing market is a lot more challenging, I would say, than the sales market. As I said, a lot of tenants are now becoming purchasers. It's much more affordable. But leasing certainly has its challenges, and now the whole phenomenon of working from home has changed that space incredibly, especially in the CBD and West Perth. Working from home has its positives and negatives, but it's certainly something that's here to stay. So businesses are going to have to be flexible and adjust to how that all looks. I think my philosophy on working from home is that it does have a lot of benefits, and I do think it has some negatives as well. You might lose parts of your culture and morale because people are in the office, and even opportunities to share information, get up from your desk, tap someone on the shoulder and ask a question. But at the same time, I get it. There's people who might be commuting 10 hours a week, an hour to work and an hour home, that now get to do a few days working from home, and their whole lifestyle improves and perhaps their performance improves.
And that would probably affect different sectors of the commercial market more than others. So
Absolutely.
This working from home phenomenon is not going to affect Welshpool.
Correct.
It's not going to affect a lot of Osborne Park or Wangara. These guys have to be on the tools.
Spot on. And that's where I specialise in commercial, so we do offices, retail sales, land development sales, that kind of thing in the city fringe. But our industrial team...
Which is a different thing, right? It's a different sector.
Absolutely. Different sector altogether. So our industrial team, the guys who are selling and leasing the sheds and warehouses in those suburbs, Kewdale, Welshpool, Osborne Park, Bibra Lake, Coburn, the boom that they've had in the last 6 months, and how often I'm hearing, we just need more stock, and these guys carry a lot of stock. They're great operators in my office. That is such a strong sign of how well the industrial sector is performing because of that shift. So working from home is not affecting the guys on the tools, as you said.
So that's a great sign. And would you say that has reflected the growth we've had in the residential space? So the industrial space has grown quite well, same as the residential, but maybe the commercial, because it's more office-based and it's got other effects hitting it that aren't a producer tenant, that the industrial, separate from the commercial, actually is comparing to the residential space.
Yeah, I would say the industrial is booming. Again, it's not where I specialise, but from the feedback from the guys in the office, they are just so busy at the moment. I think it'll continue that way. And again, it's transport, it's logistics, it's on the back of the mining boom happening up north. All of that filters through and flows through into our market. So certainly there's been an uptick in office requirement in West Perth because that's still a resources hub, but not in the same breadth, I would say, as the uptick in general requirement for purchasing and leasing industrial space in WA at the moment.
Let's talk about how these things get valued and how this goes to market, because a thing like an industrial warehouse, as you mentioned, when everyone's got work and businesses are starting up and expanding and moving, they can swing up in value massively, because the value is somewhat based on the value of the asset, the land, the warehouse itself. It's more so based on an intrinsic yield of the rent.
Yeah, that's right. So there's generally two ways you'll go about valuing a property, and that's based on vacant possession, or the other side is on what you can yield it back and cap it at that rate. So vacant possession, just a rate per square metre, as if that, say for a warehouse, office warehouse, it's empty, rate per square metre using comparable evidence in the area. And then the other side, using that cap rate, what can I rent it out for? And then you cap it maybe at 6.5%, something 7%, depending on the asset and where it's located, maybe sharper yield than that.
What it does lead to, though, for me, is a valuation of an asset where if this was a residential house, for example, it might be worth $1 million just based on comparable owner-occupied values. But because the value is actually intrinsically linked to the lease, being sort of like a term deposit substitute, and that lease in the market can be anywhere from, let's say, 5 to 8%, depending on the asset, the value of that property can be substantially higher simply just because people are buying the lease, buying the strength of the lease rather than buying the actual asset that the lease sits on, right?
Absolutely. And that's where you, again, differentiate your investor in terms of the investor who's looking for capital growth and looking for real estate that has land attached to it versus the investor who's just looking for a yield. And I suppose my advice would be, if you are an investor out there, it's very important to ensure that whatever you're looking at, if it does have a lease in place, that it's not over-rented. So make sure that the tenant is paying market rent, and in the case that it is over-rented, make sure that your final yield reflects that. So if it is over-rented, you'd like to be getting a yield that's a little bit higher, not as sharp.
Because it doesn't reflect what you might be able to get in the next lease with a different tenant.
Correct.
Let's give an example. For an office that might be getting $300,000 in rent a year, the bricks and mortar of that office might only be worth $4 million. But if you were in a market where people are happy to have that $300,000 be a 6% return on their investment, that might be worth about $5 million. Someone might pay you $5 million so that they can get a 6% return of $300,000 a year.
Absolutely. And then
that's $1 million more than what it's probably worth as a physical asset, right?
And that's where the term profit rent comes in as well. So investors have to be cautious of that if it is somewhat over-rented, it's still an opportunity to purchase it, but you just have to account for your profit rent and then account for the fact that at the end of the term, the tenant may vacate or the tenant may stay at what's called a market rent. Because you do have market rent reviews generally at the end of all those terms.
And that can go down, obviously.
Correct.
Which means the value at 6% again of your asset could be $1 million less.
That's right. So I think it's very important just to assess the rent that's being paid. And then secondly, it's also the strength of the covenant. So who's your tenant? Is it a $2 company or is it a multinational? Is it someone that's been there for a very long time? So there's a lot of value in the strength of someone's covenant.
And the length of that lease, right? If it's a 15-year lease compared to a 2-year lease, well, yes. There's that money's locked in.
Correct. That's right. So length of the lease is important. If it's multi-tenanted, look at the WALE, which is the weighted average lease expiry, and then look at the security that's in place as well. So do they have bank guarantees for 3 to 6 months? Are they a proven performer? Have they been paying their rent for the last 12 months or the last 24 months? So I think that's all very important, and general advice around when you're purchasing is not to be hasty. My advice would be do your research, take your time.
These normally do take a lot longer than a current residential investment property, for example, right? That might go in the space of a couple of days, like a property I'd be buying in Willagee right now. Bang, I need to buy it. I know exactly what it is. There's not that many factors I haven't checked off before.
Absolutely.
You would have periods of due diligence for these properties, right?
Due diligence, very common. Very common to have a period of due diligence from anywhere from 14 days all the way up to 90 days if it's a significant purchase. And that includes due diligence for the development sites we sell as well. That can be more complex than just buying a 600 square metre block in Willagee. There's all sorts of other things when you're buying a commercial development site, even if it's a future residential site that we do sell, in terms of checking zoning, R codes, densities, contamination,
and the
millions
of dollars that would have to be spent to pull that piece of land up to being a new industrial business park.
Absolutely. Yep. And
all the headworks that need to be put, the roads, all that. It's not something that you can quickly get on a calculator or a spreadsheet from what we did last week.
Correct. And that's where, if you go down the other angle, which is commercial development, you have to be ready to spend money as well, using consultants, environmental consultants and engineers and all of the above, to ensure that that project is viable, not just from a feasibility point of view in terms of if I build it, what falls out, but there's a lot of other things to consider as well, and planning, town planning, all of those things. When
we're looking to sell an investment property in the residential market, we usually want to have them vacant at the end of the day, because we know that the owner-occupier market will generally pay more than an investor.
Absolutely.
And given the fact that investors are less than 20% of the market, really niching out our buyer if we've still got tenants in there and those tenants can stay for the next 6 months. It means you're not going to get an owner-occupier buying it. So generally, if you have an investment property and you want to sell it vacant possession so that everyone can, even including investors, can buy it. From what we spoke about just then, it sounds to me you actually probably want to have a long-term tenant in there, because that's what people are actually looking to buy. You wouldn't want to have an empty warehouse unless that buyer is someone who wants to move in themselves.
Yes and no, because it all comes back to what rent is being paid. And in the last 5 years, what I've seen, and this is in the industrial and the commercial market and the retail market, is that the leasing market was further depressed than the sales market. So if landlords were experiencing high levels of vacancy for a long period of time and were somewhat desperate to put a tenant in there, how do you get a tenant in there? You have to reduce the price. Tenants lock in a deal for maybe 3-5 years at a lower rent.
Yeah, who'd want to buy that?
It destroys your cap rate.
Yeah.
So what I'm actually seeing is that unless you can rent it at a healthy rate, again, vacant possession is sometimes a better way from a seller's point of view to get a better price.
Because you might get an owner-occupier. And when we're talking about an owner-occupier, we're not talking about someone who wants to move in with the family. It's someone who wants to run their business from that office space.
That's right. So owner-occupier who runs a business, and as I touched on earlier, most likely renting, or maybe they own another property and it's time for them to expand. and they assess that cost. It's all about a cost. From a business point of view, it's not about assessing, will we create family memories here, and does this lounge room work for us and our kids, and if we have another kid, can we grow into it? From a business point of view, it's commercial. So an office is just going to look at the numbers, a retailer is going to look at the foot traffic and going to look at the demographics in the area and just see, can we make this work for our business? Is it accessible to public transport and coffee shops and for our staff to get to the office? And most importantly, does the office service and facilitate our business to do what we have to do?
When we think about that process of buying a property in the commercial space, how is it different from buying a residential property with regards to really the nuts and bolts of the conversation you'll have and the forms you sign and the finance you get?
Yep. So there's a separate O&A. It's a commercial O&A, the 810C, that someone fills out. It is very similar to the residential one. If you are buying a vacant possession, GST is exclusive to the purchase price. So you pay GST on top of whatever that purchase price is, as accordance with the REWA GST annex.
That's different, right?
That's different.
We don't like seeing GST in residential.
That's right. It's part of the price in residential, but you do pay it on top for a commercial property. If you're registered for GST, you can get that GST back. But why you pay it is you actually pay the seller's GST liability. So if the seller is registered for GST, then the buyer pays their liability at settlement. And then they can get it back afterwards. If the seller isn't registered for GST, then there is no GST. There is no GST. But often in commercial, they will be, because companies that own the properties, even individuals, can be registered for GST. If you're buying a property that has a lease in place, we sell that it's what's called a going concern. So the GST component is already built into the purchase price. So you don't pay GST on top of that, provided there is a lease in place.
And if I'm putting an offer in for a property, what would be the process there? As you said, it's quite acceptable to have a due diligence period. What other conditions in terms of finance timeframes, settlements timeframes would there be?
Generally, the terms that we ask for are quite vanilla in that it's a purchase price, your deposit that you'd be looking to pay.
Would that be 10% or $5,000 or $10,000 like in the resi space?
It depends on the nature of the property and the purchase price itself. So if it's a $2 million sale and you're offering $1,000 deposit, instantly that's a red flag from a selling agent point of view that this buy is probably not serious. So if you can get something along the lines of 10% or something that is relatively in tune with how big that purchase price is. So again, if it's $2 million,
you probably should have at least $200,000 in bank.
Yeah. But if it's not $200,000 as a deposit, as long as you're collecting something that's relatively substantial, even if it's $50,000 or $75,000 or $100,000.
Yeah, it's not walk away money.
Correct, and it's not something someone just reaches in their pocket and hands over a table. So I think that's important if you are making an offer that your deposit is demonstrating that you're a serious buyer. So again,
it's the same with residential, isn't it?
Of course, it's the same as residential, absolutely. And then the next terms that you'd have to consider in making an offer, your purchase price, your deposit, if it is subject to finance or it's a cash offer. If it's subject to finance...
Is it pretty normal for it to be subject to finance, just like in the resi market?
Very much so. And I think when I started quite a number of years ago, your standard finance would be 30 days to obtain finance. And now... I think because banks are very busy at the moment with the residential market and the volume of sales there, 45 has become the new 30.
Okay.
So the deals I've done in the last, I was even saying the last few weeks, where buyers are now saying, we'll do 30 days finance, you hit 30 days, and they said, our valuer hasn't even come out yet. Yeah, they're just all too busy.
It's not a red flag these days, is it?
No, it's not. And I think part of our job is to condition your sellers that them needing 45 days isn't actually a reflection of the quality of your buyer or their financial situation.
It's probably a reflection of the quality of the bank, to
correct,
be honest. Yeah.
Correct. It's a reflection of the banks, absolutely. And it's just timing, again. So that's part of our job, is to massage that and condition your buyers and your sellers on both sides. So 45 days is, in a lot of ways, the new 30. But if you've got buyers that can make it happen in 30, it's in our interest to make it happen as soon as possible anyway. And then you might have some due diligence attached. I generally like to run due diligence simultaneously with finance, if that's the case, so it doesn't hold up the deal any further. So rather than doing it sequentially, where you go 30 days finance and then you have 30 days due diligence, you just don't do it like that. You might say, okay, it's 30 days to do finance and due diligence. And that's in everyone's interest to keep the deal moving along.
We're using the same settlement agents. Is the process the same?
Yeah, look, settlement agents, some specialise in just residential, but you do have settlement agents who can do both.
They're still land-based assets, most of them.
That's right, yeah. There is certain things to account for as a settlement agent. If you just do residential and you're selling 3x2 villas, and then someone throws a contract on your desk for a $6 million leased investment, my advice again would be to use settlement agents who have experience in settling commercial properties, because there are certain things that you do have to understand, foreign residents withholding taxes, a few other things that they need to kind of be savvy on. So another bit of advice I would probably say is that the cheapest settlement agent is not necessarily always the best settlement agent.
The point here is a licensed settlement agent can do this. Doesn't mean, as you said, they've got the experience to do it. So probably seeing some track record, and also understanding that if the business is coming along with the sale, which can often happen as well when it comes to a retail store or something like that, there's a different settlement agent involved there, that then your normal residential settlement agent can't actually transact on a business.
Yeah, and I think that's where it just comes back to just when you employ someone and you pay them money, just check their track record and see that they've got the experience to perform. And yeah, it's certainly seen in the past where someone goes for a cheaper settlement agent, and then you get to settlement and there's issues or delays, and but if you ask that person again if they had their time over and they'd spend a little bit more money, they certainly would.
Let's talk about the leasing process when it comes to commercial and how that's different to residential. Now, when we think about the residential space, the lease is pretty standard. It's a REWA form. We've got our lease amount, our terms of whether we can have a pet involved, how long it's going to go for, how often we're going to pay the rent.
Sure.
But it stays at that, right? When someone leases a residential property, they will pay the lease.
Yep.
And they will pay for their own utility consumption.
Mm-hmm.
How is it different in the commercial space?
It's certainly different, and these leases then impact you as an investor if you're buying a commercial asset as well in terms of the outgoings. So,
what's an outgoing?
Yeah, so outgoings, you have what's called statutory outgoings and then variable outgoings. So outgoings are your council rates or shire rates, water rates, strata levies, insurance, and then even if it gets to a point of variable, you might talk gardening, maintenance, all of those items. So if it's generally capital in nature, the landlord is responsible for that. If it's repairs and maintenance, that's a tenant expense in commercial real estate anyway. So in commercial leases, all those items I just listed, the tenant is responsible to pay all of those things. And that's another kicker. As an investor, you don't pay those things. So it does make commercial investment somewhat attractive as well.
Well, it's a net amount, really. When you think about a lease maybe having a 7% yield, that 7% isn't eroded by all those rates that you have to, as a tenant, you have to pay the land tax.
Land tax as well.
The land tax of the owner, which is just, it's
Yeah.
crazy to think that you're paying someone else's bills. But that is the reality, is that
commercial practice,
when you're getting a 7% yield, that is not eroded by all the things that in a residential space, and we think, the residential yield has gone from 3.5% to 4.5%. Well, actually, it's probably gone from 0.5% to 1.5% net, because we still have to pay our property management. We still have to pay all the rates. We still have to pay land tax.
Correct. So
right?
if you invest in an apartment and then you rent that apartment out, you're still paying those strata levies, those council rates, those water rates. On the other side, you buy, let's say for comparable, a strata office, right? So an apartment's a strata office, residential versus commercial. Your tenant pays all of those bills. What's the risk versus reward? You're probably got more chance, especially in this market, of renting that apartment out with less headaches and more applications than you would for a strata office, for example.
That's why we accept a far lower yield net
Correct.
in the residential space, because we probably could rent that out within 2 to 4 weeks compared to the commercial, industrial, retail space, where this is where the risk is built in.
Correct.
These places can sit empty, and we need to make this very clear to people, for years.
Yeah, and I think that depends on the pricing that you're after, the property itself. A lot of landlords give advice when it comes to leasing agents around. They get advice that they need to do up the property, and such a cliche line is, I'll do it up once you find me a tenant. But the proactive landlords, the ones who actually spend the money to attract the tenant.
And then they can have a higher rate as well,
of course
probably,
they do.
in terms of
and
the
they're
lease.
the ones who often win out, because they've actually gone and put their hand in their pocket. They've spent the money. They've then attracted a tenant, because the tenant's probably seen it online or walk through and go, I don't have to visualize what this is going to look like. It already presents well. And you don't have to do a Hollywood fit out. But in my opinion and advice, it's all about having base build presentation.
There's nothing worse than walking into an office space that you can clearly open the door and smell it hasn't opened for years.
Correct. That musty smell. So it's important. And when I say base build, carpets, ceiling, lighting, air
Paintwork.
conditioning, paintwork, you know, just the base build.
It's not a lot of money when you think about this.
I'm
Thing's
not,
probably worth millions of dollars.
That's right. And I'm not saying you don't need fancy glass partitioning or polished concrete floors, but it is just those base build things to present better, and that gives yourself the best chance of finding a tenant. And I find if you price it correctly, you listen to your agent, if your agent's giving you, real feedback as well, because often an agent can say at the start of a campaign, I think it's worth this much a square metre to rent, and then you might have 5 different parties come through and they're all banging down at a lower figure, and that's market feedback.
It is market feedback, and the reality is if you go and spend $40,000 doing up your office or your retail space, and that means that you can now charge $50 a square metre per year more.
Yep.
What that means is you're probably worth a few $100,000 more now as a reflection of that cap rate.
Correct.
So you spent 50, your asset's now worth a couple $100,000 more. It just seems logical to me.
Absolutely. And it's just I suppose the wrestle leasing agents will have is with their landlords is just getting them to spend the money.
In residential, you don't really know when you do a reno how much you're going to get back for it. Whereas in commercial and retail, you actually do know pretty strongly what that's going to reflect at.
And I think that comes back to that point as well in terms of when businesses are looking to buy or businesses are looking to lease. It's just a numbers game. It's commercial. You take that emotion out. There's sometimes a little bit of emotion, but generally you take the emotion out so you can quantify how much you spend and how much you really hope to get back out of those investments into your own buildings and properties.
Last thing we'll do before we finish off is just explain how that leasing number looks like, right? So when you go on realcommercial.com.au, for example, contrary to a residential lease, which might say $450 a week.
Yep, absolutely.
A commercial space might say $100 per square metre plus outgoings.
That's right.
Can we explain what that actually means?
Yeah, of course. A good example, say you go on realcommercial.com and you see a warehouse in Wangara and they're asking, as you say, $100 a square metre plus outgoings, and then generally it's plus GST on top of that as well. Carbays can be on top as well. Carbays generally charged for areas where carbays are a commodity. So very rare that carbays will be charged industrially. But when you start to look at suburbs, West Perth and Subiaco.
Well, here at the studio. Yeah.
North Perth, absolutely CBD, where carbays are a commodity, even Nedlands and Claremont, then there is generally an additional charge per bay per month for those carbays.
Plus GST.
Plus GST again, yeah. So it can add up. So back to the point of $100 a square metre. Say you've got a 400 square metre office warehouse at $100. The $100 is actually a per annum figure. So 100 by 400 is $40,000 per annum. Plus your outgoings.
And what might that be?
Well, the outgoings do differ. Again, it's the same principle. I find that the closer you get to the city, the higher they are. And then it depends if it's a strata or if it's green title, if those levies are included.
Will they scale that as like a per square metre number for you as well, so you can just work it out? Correct,
that's right. You can give it as a total figure, and generally no one's really making money out of the outgoings, but it's a total figure or rate per square metre. So industrially, it's a lot less. Commercial can be a lot higher. For example, commercial buildings have lifts. Industrial ones generally don't. So the tenants pay the lift levies, which keeps the lifts running up and down and maintaining them.
Of course.
And that kind of thing. So
it might be $100 a square metre for rent and then $100 a square metre for outgoings.
Yeah.
So that 40 turns into 80.
Yeah.
And then another $5,000 worth of car bays if you're close to the city.
If you're close to the city, that's right. So if you're going industrial, it's more likely it could be anywhere between $25 to $40 a square metre on your outgoings. But as I said, it does depend on the nature of the building that will determine your outgoings. Another point I should mention as well is your management fees. If it is a commercial lease, so non-retail, those management fees are recoverable from the tenant, not an owner's expense. So
making it look really attractive to be a landlord of commercial if you've got something that's rented out.
Correct. If it's retail, the landlord has to pay management fees as per the Tenancy Act. But if it's non-retail, so if it's commercial, industrial, medical, that's an expense that the tenant covers for a landlord as well.
Luke Randazzo, Burgess Rawson, really appreciate you coming in, mate. It's been really insightful and really informative chat about how those differentials sit, because a lot of people, I think, they don't even venture into commercial because they don't know where to start. They don't want to ask the silly questions, and I guess this is what this podcast is about, right? So thank you very much for coming in, chatting, and we'll chat about more of a market analysis very soon.
My pleasure. Thanks, guys.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!